Hey, good morning, everyone. I hope you're doing well. I've been away for a while. I actually took some personal time off. Was the perfect time to get away because I know the 2 to 3 weeks preceding earnings season are typically the slowest in each quarter. But so it was a good time to take some vacation. But I'm back now, ready to trade the earnings season that's actually upon us. And today was a bit of a slow day, and I had a few minutes to spare, so I thought I'd come on and show you something that I learned a long time ago because it's relevant to what's going on in the market today. The idea is if you have a wide range bar, it is not to be considered significant unless it produces follow through. Unless you get another bar that clears the high of the wide range bar. So if you get a wide range bar that's coming out of a base, and this is a pattern that we call a breakout pattern, and the wide range bar is followed through on by an inside doji bar, an inside small bar like so, then you're either going to get a 1, 2, 3. You're either going to get what is known as a 1, 2, 3 pattern higher, or you're going to get a breakout failure. A breakout narrow range bar. Sometimes we get multiple narrow range bars also, 2 or more, and then a breakdown. If the stock or the market breaks under the narrow range bar's low, then you're most definitely going to get a breakdown failure, which means if your stop is under the base, you don't want to keep it there. You want to actually raise your stop and trail out the position. All right, let's take a look at a couple of examples. All right, the concept is most trends end in exactly the same way. The stock puts in a wide range bar followed by one or more inside narrow range bars, which is what I said. The stock then breaks under the low of the inside bar and begins to break down. This is what I call the breakout with no follow through. And it's how 90% of all trends end. It's also how most breakouts fail. It's something that I actually learned on my own a long time ago, so you're never going to find this in a book or a seminar. So let's say you were long this stock, and this is a 5-minute chart, or maybe you played the breakout, and then you see that the breakout, we got the wide range bar, the huge igniting volume, and you see that the wide range bar was followed by a narrow range bar. Where would the correct exit be? Where should you trail the position? Should you keep your stop under the base, which is where it typically is when you're playing a breakout? That's typically where I usually put my stop. No, the answer is you should look to exit here. And sometimes the truth is, sometimes I exit the position there and the stock comes in and then eventually goes higher. And I basically get shaken out of a breakout play. But the vast majority of the time, if you get this pattern, if you get this breakout failure pattern or breakout with no follow through, then the stock is most definitely going to break under the base, which means your stop is going to get hit. So better yet, better than keeping your stop under the base is to raise it here. This way you actually make a little bit of money, or at least you don't lose money. You trail out at break even. The same here. Let's say you're in the stock short and you get the breakdown that's followed by a narrow range bar. Where should your exit be? Should you keep your stop where most people put it, which is above the base, or should you actually exit your position right there? The answer is you should exit the position at the bottom. That's what I personally do. And again, sometimes I exit here and the stock actually doesn't take out the base, meaning if I had kept my stop above the base, I wouldn't have gotten stopped out and I miss out on the move. But that's rare. Typically, if you get this pattern, the base is going to fail. Now, with this little tactic, that I call it the exit rule, right? that I shared with you, now you know how to eliminate most breakout or breakdown failures. This is also how most trends or most moves end. So now you also know how to spot the end of the move and trail your position. Or if the stock is going, let's say, climactic, you can actually initiate a new short, meaning you can go counter trend. All right. I'll show you that in a few minutes, how to do that. But some additional notes. First, the exit rule is not a strategy. You can't go around looking for breakout failures to fade. That would be counterproductive. You have to understand the larger context before you go against the trend. But the more important note that I want to share with you here is that the exit rule that I just shared with you applies to daily charts when swing trading in the same exact way as it does to intraday charts. However, if you don't heed the message, when you're keeping things overnight, keeping positions, the consequences can be devastating. For example, here's a stock that had a beautiful breakout that I was in, and then the next day put in a narrow range bar. The third day I was out. If I didn't, a 20% gap down, I think. Or maybe was it 10% gap down, right? Does that make sense? So the correct exit for this would have been right here. If you didn't, then the next day it gapped down a huge amount, about $1 something, so about 10%. How about this? Again, beautiful. These are things that I was in myself. Here's a stock where it put in a beautiful breakout. Well, this is the breakout, right? And then the breakout bar, the wide range bar, was followed by a narrow range bar. So where was the correct exit? Here. If not, then the next day, bam, you're down a lot, right? You suffered the gap down. Sometimes breakouts fail for no apparent reason, like this stock I was in also. 15% move that day. I thought it looked perfect. Nice low volume on the while it was basing, high volume while it was moving up, meaning the professionals were buying it. It printed a beautiful breakout. I thought it was definitely going to 20. The next day it printed a what? A narrow range bar. So under this bar is low. If you don't exit, then where would you exit? Here, once it breaks under the base and you give everything back? No, that would have been the wrong place to exit. So this is how most trends end, but it's also how most breakouts fail. More examples. This is a stock that, to tell you the truth, I tried to short it 3 times and it failed. I'm not showing you, this is a daily chart. If you looked at the monthly chart, you would have seen how, if I had taken a picture of the monthly, you'd have seen how climactic this was. Tried to short it here, didn't work. I don't know where else I tried to, but I tried to short it 3 times. Didn't work. And then how did it eventually top out? Through a breakout failure. Broke out just a little bit, and then the wide range bar was followed by a narrow range bar. That should have been the short actually, right? So that's how it topped out, and from there, from $70 it dropped to 40 in just a matter of a couple of weeks. This is NUS. I was in it too. Breakout, gorgeous, just a beautiful, beautiful breakout. Look at this, beautiful breakout. Did the breakout follow through? Did the breakout bar produce follow through? It didn't. It produced narrow range bars. So out this day, if not, that was a 20% gap down. Then, this is how you avoid getting sucked into positions that look really good, but only end up in devastation, basically. So now that you've learned how to trail or how to avoid a breakout failure, how to trail a position that you might already be in, let's take this a step further and use the exit rule as an entry tactic. So remember this stock, this chart? We had a climactic sell-off and then a breakdown. Look at the 15-minute chart. The stock had dropped from 112 to 105, 106. Look at this, down a lot, basically climactic. Breakdown, now you can flip it, right? Because the stock was actually already set up as a long, as a climactic buy. Long, stop. Exit, that's target 1, target 2. Beautiful. Here's a stock that gapped up. This was a professional gap up. And then look at how the pullback ended. Down, 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 breakdown, followed by a narrow range bar. That's what actually we call, what we actually call a pullback, a buy setup, a pristine buy setup, like so. Now it doesn't look like the typical buy setup because the pullback ended with a breakdown failure. So in this case, it would have been the perfect entry to play long right here, stop right there. Does that make sense? So this is how most, again, pullbacks end, how most breakouts fail. So you might think that, oh, so after every wide range bar, if I see a narrow range bar, then I have to exit the position, or I have to initiate a new short position. Here's a wide range bar followed through by a narrow range bar. Does that mean I have to short here? No. So the question here is which one was a valid breakout with no follow through? Here's a wide range-ish bar followed by an inside bar. Here's a wide range bar followed by an inside. Which one of the two? And the answer is the second one. Why? Because this tactic that I'm sharing with you is only valid if you have a base. Notice before this wide range bar, we didn't have a base. We just had a move up, an up move. In this case, we did have a base and then a breakout. So this tactic, again, that I'm sharing with you is only applicable if the stock has rested first. Okay, if the stock based out first and then broke out. Does that make sense? So that's how you do it. And then there's another one where the stock was actually climactic. It never gave a good entry. So the best entry that it gave was the breakout followed by a narrow range bar, short, right? And then stop, target. It continued lower, but that was the target. Wide range bar after multiple bars down, that's target. Okay, all right. So those, that's kind of some information that I think is very, very valuable because again, you're not going to see this in a book, and I just learned it from looking at charts, millions and millions of charts. But I thought about sharing this lesson with you because I saw the same thing happen in the Qs yesterday, where we had a wide range bar to all-time highs, by the way. So this is the daily chart of the QQQ, which is the tracking ETF for the NASDAQ 100. And then the wide range bar was followed by what? Two narrow range bars. So I already was thinking, we might be failing. Does that make sense? If not, then that would have made for a nice 1, 2, 3, 4 pattern. 1, 2, 3, and then 4 the breakout. So most people think, oh, let's get in long here. Nope, because then we had a 1% gap down today. Of course, the market in this case got bought. So if you actually did buy it here or there the last couple of days, and you held on to the position today, you didn't panic out of it, sure, you would have made your money back. But what if the market didn't get bought and just continued lower? So the point is, that's not, that's when I see a pattern like this, that's when I think, uh-oh, we might be getting a breakout failure. When I see, let's say, a breakout like we got here, and then the next bar takes out the first bar's high, then that's a good, healthy breakout. Does that make sense? So there's the breakout. The next bar was not an inside doji narrow range bar. It actually followed through. Okay, no problem. That's perfect. But when I see a wide range bar, where is it? Here, broke above the base, followed by, then I start to think, uh-oh, we might be getting, I wasn't in USO, but I was in oil long. So I didn't, again, wasn't in USO. Look at USO. We didn't have a base, but broke out to new highs. And then what was it followed through? It was followed through on by a narrow range bar. Failed. The breakout now, if you were to consider this a breakout, failed. I was going to do the CRK just a couple days ago, I think a few days ago, as a long. Here it is. Why do I like it long? Because of the monthly chart. It's a transition A on the, let me just show you for a second here. It's a really, really nice looking monthly chart. See this? I mean, that looks gorgeous. Long over the base. So I was getting ready to play it long, as a 1, 2, 3 pattern, but so it already broke out here. I got the 1, 2, 3, so I was going to play it long. It failed. So far, it failed. See this? Wide range bar followed by what? A narrow range bar. So it's not the day to get in it. You'd have to wait for the third day. In this case, the third day already took out the second day's low, right? And then yesterday gap down, so failed. So again, it's something that I always keep in mind because I see it all the time, all the time. If you get a breakout and the breakout the breakout is followed by another bar that takes out the first bar's high, no problem, you can keep the position. But if it's followed by a narrow range bar, that's when you want to tighten the trail. Or if the stock is really climactic, that's when you want to look to go short, perhaps. So I hope you enjoyed today's lesson. I'm going to be very busy the next 3 weeks or so, next couple of weeks with the earnings season. So if you'd like to, if you're a day trader, want to participate in some of the day trades that I will be taking, please feel free to check out the Black Room. That's where I spend my whole day, and let me know what you think. I hope you're doing well and have a nice rest of the day. Take care, everybody.